Stop watching Tesla's delivery numbers. Seriously. If you think 480,126 vehicles sold is the story, you've already missed the point. Here is the counterintuitive truth that every Tesla investor needs to understand. Tesla delivered a record 480,126 vehicles in Q2, up 25% year-over-year and 34% sequentially. That's Tesla's strongest second quarter ever. But the stock is down 22% from its 52-week high of $498.83. Why? Because Tesla trades at 360 times earnings. Investors paying that premium aren't buying delivery counts. They need evidence that Tesla can turn this volume into profit. The one number that matters on Wednesday, July 22, automotive gross margin excluding regulatory credits. It has expanded 4 quarters in a row, from 12.5% to 19.2%. If it hits 20% plus, the stock could soar. If it stalls, the 67% downside Wells Fargo warns about becomes real. Let me break down the earnings preview. I'll admit something. I saw 480,126 deliveries and thought, this is great. Stock should go up. Then I checked the valuation. 360 times earnings. 22% down from the high. A $130 price target from Wells Fargo implying 67% downside. And I realized, the market is pricing in PERFECTION. Today, I'm going to break down Tesla's Q2 earnings preview. By the end, you will understand why Tesla's earnings could go either way. Let's start with what we already know. The number, 480,126 vehicles delivered in Q2 2026. The breakdown, 467,762 Model 3 and Y, and 12,364 other models including S, X, Cybertruck, and Semi. The growth, up 25% year-over-year and 34% sequentially. The beat, analysts expected roughly 406,024. Tesla beat by over 74,000 vehicles. The context, it's Tesla's strongest Q2 ever, surpassing Q2 2023's 466,140 deliveries. Why the surge? Gas prices from the Middle East conflict pushed consumers toward EVs. Europe showed robust momentum. China rebounded strongly in May, snapping 2 months of declines. The counterintuitive truth. Delivery numbers are old news. They were announced July 2. The stock actually dropped 7.5% that day because the good news was already priced in. Now let me show you the one number that will move the stock. Automotive gross margin excluding regulatory credits. The trend, Q1 2025 was 12.5%. Q2 2025 was 15%. Q3 2025 was 15.4%. Q4 2025 was 17.9%. Q1 2026 was 19.2%. 4 consecutive quarters of expansion. Why this matters? Tesla trades at 360 times earnings. That's not a delivery multiple. That's a profit multiple. The hope? Margins will hit 20% plus this quarter. The worry? Cost cuts won't offset price reductions. The gap? Wells Fargo sees $130. That implies 67% downside. The bulls say AI and energy storage will transform the company. The counterintuitive truth. If margins hit 20%, the stock could soar. If they stall, the Wells Fargo target is real. Now let me show you the other standout. Energy storage deployments, 13.5 gigawatt-hours in Q2 2026. Growth, up 40% year-over-year and 53% sequentially. The driver, stronger than expected demand for Megapack and Powerwall. The revenue opportunity, analysts expect energy storage revenue of $3.55 billion in Q2. Services and other, including FSD, are expected at $3.80 billion. The diversification, Tesla is no longer just a car company. Energy storage is a legitimate second growth engine. The counterintuitive truth, energy storage revenue is growing faster than automotive. but it still accounts for a small portion of overall revenue. This is a long-term diversification play. Now let me talk about the future. Robotaxi, 5 markets live including Austin, Dallas, Houston, San Francisco Bay Area, and Miami. 4 more queued for expansion. Safety data shows 22 incidents reported since launch, with no serious injuries or deaths. Optimus, July end production start at Fremont. Supplier orders of 1,000 robots per week by September, and 2,000 to 2,500 per week by year end. Third General Optimus could be unveiled soon. FSD, 1.28 million active subscribers, up 51% year over year. The CapEx cost, Tesla raised 2026 CapEx forecast from $20 billion to $25 billion. Free cash flow could turn negative. The counterintuitive truth, Tesla is spending billions on the future. Investors want to see progress, not just promises. Let me leave you with the 3 secrets that connect everything we just discussed. Secret 1, the margin expansion signal. 19.2% margins in Q1. If Q2 hits 20% plus, the stock re-rates. If it stalls, the 67% downside target becomes real. Secret 2, the energy storage diversification. 13.5 gigawatt-hours deployed. $3.55 billion in revenue expected. This is Tesla's second growth engine. Not FSD, not Robotaxi, energy. Secret 3, the CapEx burn warning. $25 billion in 2026 spending. Free cash flow negative. Tesla is betting the farm on AI and autonomy. If it pays off, the upside is massive. If it doesn't, the downside is severe. So what should you actually do with this information? If you own Tesla stock, the delivery beat is already priced in. Watch the margin number. If automotive gross margin hits 20% plus, the stock could break out. If it misses, expect volatility. If you are a trader, options markets are pricing a 7.6% move after earnings. The consensus EPS is 55 cents. If Tesla beats, the stock could rally. If it misses, the downside is real. If you are skeptical, Tesla trades at 360 times earnings. The valuation is extreme. Wells Fargo sees $130. That's 67% downside. Wait for margin expansion to confirm the thesis. Here is my question for you. Do you think Tesla will hit 20% automotive gross margins this quarter, or will margin expansion stall? Drop your answer in the comments. I read every single one. Like and subscribe if you want more analysis on Tesla, AI, and the companies reshaping the industry. I'll see you in the next video.